Thank you for joining me. I'm Alex, and I want to talk about Netflix. So, they have streaming video, it's pretty well known at this point. Current price is $523, which gives them a market cap of $231 billion, which is pretty high in my opinion, considering they didn't really exist. 10 years ago, they were still have some of their DVDs. Revenue $25 billion, earnings $2.8 billion, current PE is 93 with a forward PE of 58, which is better. Not great, but better. Better is good. Dividend is 0. I don't expect that to change anytime soon, although if they keep pulling in this kind of profit, it might happen, but I definitely wouldn't count on it. Total assets $39.3 billion, total liabilities $28.2 billion, which gives them a total stockholders equity of $11.1 billion, which is still just 5% of their market cap, which is not quite there. I would prefer higher stockholders equity, but obviously software company basically, so they don't really need a whole lot of assets. Risk factors being Disney Plus, Apple Plus, HBO, YouTube, obviously, Twitch. There's many others, so many others. I kind of don't see them losing the battle, though. They're very well established, and the whole market just has way too many streaming services right now, and I think that eventually things will thin out a bit, and I do believe that Netflix will come out on top eventually. They also do have a whole lot of shows that they produce, so I don't think that because of what they own, they will be one of the smaller players. I believe that eventually the consolidation will happen and they might buy a couple of the other ones, but that's going to probably happen over the next decade or so, not anything very short term. So overall, for a growth investor, I think that obviously 25% growth is pretty nice. I'm not sure if it's enough, and I'm not sure if it's sustainable at 231 billion market cap. If I were a growth investor, I would probably opt for a smaller company that has more room to grow. I think that Netflix being well established at this point and kind of not having room to grow either subscribers nor revenue is kind of a problem for a growth investor. So not a bad company. I would probably look elsewhere though. The forward PE of 58 is pretty nice for a growth company, so definitely wouldn't blame anyone for buying it. I just think that there's better companies out there. For a dividend investor, obviously the lack of a dividend is pretty much a deal breaker. Don't really think that anyone can count on there being a dividend, and who knows when, if there will be a dividend. So for a value investor though, the balance sheet looks decent-ish. The PE is just way too high, and the growth I don't think quite makes up for that. So even if they can hit their forward PE of 58, that's still about 3 times what you want for a value investor, and that's a growth of 50ish%. So not really expected that they can continue that long enough for the stock to make sense for a value investor. So overall, I think that value investors also can find better opportunities elsewhere, but again, probably wouldn't blame anyone for buying this even at the current valuation, because if you hold the stock long enough, I think that it will be worth it, because Netflix will probably stick around for a few decades. But hard to project anything that far out these days. That's it for me for today. If you like this video, make sure to subscribe and comment more videos every day before market open. I hope you have a successful day.